Welcome back to another video. Today we're going to be taking a look at how many rate cuts are expected in the second half of 2025 as well as into 2026. We've heard a lot of talk about how many rate cuts are happening, when the Fed is going to finally start and confirm their rate cutting cycle, because there is a lot of talk about some cracks in the economy, the unemployment rate slowly starting to increase, and so many people are stuck in the housing market waiting for mortgage rates to finally drop back into the low sixes, mid to high fives. So the Fed cutting interest rates is going to change things substantially, and I want to take a look at the exact data and see how many rate cuts we are expecting this year as well as into 2026 to give you a good idea of when you could potentially dive back into the housing market or how long you're going to need to wait for lower mortgage rates, because it does make a huge difference, particularly for first-time homebuyers. If you're new to the channel, my name's Ian Phillips. I'm a realtor in Southern California, and I love everything housing data, talking about what's going on in the economy as well and how it's going to impact the housing market. So if you like this video, subscribe for more, and let's get straight into the data. So this website is indicating the odds of rate cuts every single Federal Reserve meeting, and historically it has been very, very accurate. So looking at this data, we can kind of get an idea of when the Fed is going to do their first rate cut in 2025 and how many rate cuts they're going to do for the rest of the year as well as into 2026. I also want to talk about what impacts interest rate cuts. We're going to look at inflation and the unemployment rate, because those are the two largest factors that the Fed is looking at when determining how often and how frequently they're going to cut interest rates. So as of right now in June, there is a 97% chance that the Fed is going to keep interest rates the same. So the current target rate right now is 425 to 450 basis points, or 4.25% to 4.5%. If we look at July of this year, right now the odds of rate cuts staying the exact same as where they are is 70%, and then a 30% chance of one rate cut or a 0.25% rate cut. If we also look at September, this is when things finally start to change. Right now, there is a larger percentage of having at least one rate cut of 0.25% and only a 25% chance of keeping rates the same. We also start to get into the idea of potentially cutting rates by more than 25 basis points, or 0.25%. You can see there's almost a 20% chance that the Fed is going to do a 50 basis point rate cut in the month of September. So as of right now, we almost have a guaranteed chance of having one rate cut in September. Now, I know a lot of people were anticipating rate cuts to happen sooner, and in all honesty, so was I, particularly because we got 2 to 3 rate cuts in the last 3 months of 2024 when the stock market was at all-time highs, unemployment rate was down, and the economy was growing pretty steadily, but all of a sudden in 2025, they no longer want to do rate cuts. Kind of strange. But if we look at October, there is basically a 48% chance that we're going to have another 25 basis point rate cut, and almost a 50% chance that we're going to keep rates the same as the rate cut in September. So odds of multiple rate cuts are not that likely in 2025. So the Fed skips a meeting in November. So if we only get one rate cut in September and no rate cuts in October, there's a good chance we're not getting another rate cut until December. And that brings me to this month right now, where the odds of a rate cut is basically guaranteed to have at least 50 to 75 basis points lower than we are currently at right now. Now, potentially we get 4 rate cuts before the end of the year. That is the absolute best case scenario according to this data. Worst case scenario, before the end of this year, we only have a 50 basis point rate cut. Basically, rates will be 0.5% lower than they are today. Now, I know that is not a lot, but on the good news is into 2026, the odds of rate cuts start to increase. You can see we're expecting 350 basis point as the base rate starting in January of 2026 and potentially going to 325. And then if we go to March, there's no meeting in February. The odds of rates being 1% lower than they are today is basically 100% guaranteed by March of 2026. Now I want to talk about what could impact the Fed's decision leading into the second half of this year on determining whether or not multiple rate cuts might actually be mandatory. As of right now, remember, we have a guaranteed 50 basis point rate cut, or rates will be 0.5% lower than they are right now. And potentially, on the best case scenario, rates will be 1% lower than they are right now by 2026. So if we look at the unemployment rate, which is a huge factor that the Fed looks at when determining if they want to cut rates. And we will look at, so the gray areas here are every single recession that we've had. And this is a 2008 financial crisis where you can see the unemployment rate absolutely skyrocketed, and we are not at that stage. Now, could unemployment skyrocket in the second half of this year into 2026? Potentially, but we've had a very slow increase in the unemployment rate. In April of 2023, it was 3.4%. And fast forward to now, as of making this video, the unemployment rate is only 4.2%, which, looking back at the chart, is pretty low historically. You can see even leading up to the dot-com bubble, the unemployment rate was around 4% in the year 2000 and then went to 5 to 6%. Now, in my opinion, if we get a couple months in a row where the unemployment rate starts to increase, solidly stays above 4.5%, I think the odds of the Fed cutting rates 3 to 4 times is going to increase. But if we get the unemployment rate staying where it is right now, around 4.2%, staying in the low fours, doesn't really get above 4.5%, we're probably just going to stick with that 2 rate cut scenario by the end of 2025. Now, what we don't want is for the Fed to be too late with cutting rates, and then we get a situation like this where the unemployment rate skyrockets. Looking back historically, through all recessions, you can see this is the inflationary recession between the 70s and mid 80s, where inflation was like 15%, and we got mortgage rates as high as 17, 18% around this period of time. And what we don't want is for the Fed to be too late. If the Fed is too late with cutting rates, we can't get the economy to stimulate enough. We can't get enough people to borrow money fast enough to start that growth cycle happening before you get mass unemployment. We got very high unemployment in the 80s. It went as high as 10%, which is exactly where it went during the financial crisis, where the housing market crashed 50%. So the unemployment rate is a key metric to keep an eye on. And I know a lot of people like to cite inflation because there's a lot of unknowns around inflation right now. But one of the Fed's key mandates is to maintain the jobs market. And they will really only start cutting rates multiple times if the jobs market is increasing a little too fast. So if we're in a scenario where the unemployment rate is somehow at 5% by the end of this year, they absolutely need to start cutting rates, because that could be a scenario where the unemployment rate could quickly get to 5.5%, 6%, 7%, 7.5% in the first half of 2026. And that is not something we want to do. We want the Fed to be in a situation where they are cutting rates ahead of unemployment increasing, because that will stop it from getting out of control. Another one, obviously, like I mentioned, inflation, which has been on a huge downtrend for the last couple years. You can see in June of 2022, inflation peaked around 9%, and now we're sitting at 2.3%. So a huge drop in inflation. Inflation is just the rate at which goods and services are increasing. So when inflation drops, doesn't necessarily mean everything is getting cheaper. It's just not getting as expensive as quickly. So this is where we had the inflation recession, so to speak, in the 70s and 80s. You can see it went to 12% and then it went to 15%. And this is what the Fed right now is trying to avoid. They don't want to get into a scenario where they cut rates too soon and then we get this huge second wave of inflation, which would absolutely be devastating for the housing market. So I think that's why they are potentially a little late to the rate cutting party. They just want to sit on the sidelines and kind of see how everything plays out. Because although if they cut rates too late, the unemployment rate could get out of control, if they cut rates too soon, then inflation could come soaring back, which kind of begs the question as to why did they cut rates 3 times in the second half of 2024? Very bizarre rate cutting period of time. I don't really know, no one I know can explain why they decided to do that, but nevertheless, here we are. So that's kind of an explanation on where interest rates could be headed in the rest of the year and into 2026, as well as what impacts the Fed's decision to cut rates. As of right now, inflation has been on a great downtrend. If we could solidly stay below 2%, I think that would give the Fed a little more confidence to cut rates multiple times. And the unemployment, in my opinion, is what everyone needs to be paying attention to determine if we're going to get 4 rate cuts this year or only 2 rate cuts in 2025. As of right now, if you're a home buyer, you've been waiting on the sidelines for mortgage rates to get into the 5s. The data is suggesting that we probably won't see that until 2026. But if we get unemployment increasing and inflation solidly staying around 2%, hopefully below 2%, then we could actually have mortgage rates in the 5s by the end of this year. Let me know your thoughts in the comments. Once again, if you like this video, subscribe for more. My name's Ian Phillips. I'm a realtor in Southern California, and I'll be uploading weekly, if not daily videos, diving into the housing market, talking about what's going on, how the economy impacts the housing market, and a lot of data, as I love looking into the data. I'll see you in my next video.